Hey, good morning. Good morning. How's everybody?
Good morning, Professor. How are you?
Good, good. How are you, Richard?
I'm fantastic.
Oh, good.
Thanks for
That's very
asking.
good. At least, one high-spirited one high-spirited student this morning. Um, I'm seeing six people currently in the collaborate session, but I before I came to the collaborate session, I checked the discussion board, and nobody was there in the discussion board. So let me just take you back to the discussion board and let's see who's there. Um, okay, now I see more people in the collaborate session. Okay, um, but if you haven't signed into the collaborate session, please do so right now because think about it. It's very important to it's very important to establish your physical proof of attendance because later on, and if you forget, and the class after the class is dismissed, and you just keep forgetting it because the class is over. And although I leave the forum open until the midnight, 11:59. The chances are you will never, suddenly remember and oh, gee, I forgot to sign in, so I gotta go back, get back there, and I mean this won't happen. The chances that this will happen is very low, and then there is no physical proof of your attendance. I wouldn't know. I mean, I don't have a photographic memory, right? Nobody has a photographic memory. I wouldn't know. And although I can read the names here right now, I can see the names here right now. But after the class is over, I will have nothing to. I cannot remember who were, and constantly people get come in and out. Constantly people get connected and disconnected. And so look, don't expect me to remember all of your names. Okay, it's your responsibility
Professor,
to,
sorry,
to sign
just a
into.
quick
Yeah,
question.
yeah, yeah.
Do you want us to put the attendance before we come into the collaborate session?
Yes, yes, definitely. You see, that's what I declared. That's what I clearly stated in the class protocol. Okay, the first order of business is to sign into the sign-in sheet, and we have a digital sign-in sheet, which is the forum. I mean, you can ask questions there, but most of all, you leave your digital footprint, right? Leave your digital footprint of attendance, and that's the only recourse I can fall back on. I mean, to check your attendance, right? Remember, you get 0.167 point for attendance, and you lose that if you don't have it, right? And that's the only thing I can fall back on. Otherwise, how do I have no way to check. As I said, I don't have a photographic memory, right?
Okay, sounds good. I'm used to signing in first and then doing the discussion board, but I'll make sure I do the discussion board first and then come
Yeah,
on.
yeah, yeah.
All right,
Sign into the discussion board
very well.
first. All right.
Thank you,
It doesn't
Professor.
take. Yeah, you're welcome. It takes only like 1 minute, right, to just put your name there, and that's it. You don't have to post anything. Just put your name there and post it. That's it. All righty. So let me. So last week, let me take you back to what we were doing last week. Of course, we were talking about the structure of the income statement and the mainly structural aspect, because each line item, right? Each line item, it's the logical result of the structure, right? It's the logical result of the structure. So you don't have to get bogged down with, the small line names of the small line items. What you need to have a clear picture of is the big structure, and then because income statement is original name. I mean, the full name of income statement is income and expenses statement. So obviously, the idea is to subtract all the expenses from income, right? I mean, that's the rough idea of profit. Subtract the expenses from income, then you arrive at profit. But that profit is not the net profit yet. That profit is called operating profit or EBIT, right? But the idea is then, let's now get down to the details of the income and expenses. If you think about then you come down to the realization that there are two major sources of income, and then which are sales revenue and the investment income, and then investment income is also called capital income because it's basically the result of investing your capital. And then there are also two major sources of expenses, right? Total direct cost and indirect cost. Direct cost is called total variable cost in microeconomics, or CGS, cost of goods sold, or cost of revenue in accounting. And then indirect cost, which is also called total fixed cost in microeconomics, and which is roughly equivalent to the operating expenses in accounting. Okay, OPEX. So so you subtract them. You subtract CGS and OPEX from the income, then you arrive at operating income or operating profit, also called earnings before interest and taxes, or EBIT. Now, all these different terminologies, you at first you find them, unknowing because too many, but it's just you will come. The more you look at it, the more you study, you will come to the realization that it's just the same thing, just called by different names because you look at it from different perspectives, right? And then and I like this this column of naming, because it's very logical, and it's also self-explanatory, because EBIT literally means earnings before interest and taxes, and then it tells you, that already gives you an idea what is going to happen next, right? The name says it all. The name already says it all. It's earnings before paying interest and taxes. So, what's the next? Next will be paying out interest, right? And then after paying out interest, then because I is taken out, I is gone, it should be called EBT, earnings before taxes. So it's very logical and very self-explanatory. And EBIT, since EBIT, that's earnings before taxes. So then it tells, already the name itself is predicting what should happen next. What should happen next is paying taxes, right? So hence another name for EBT is taxable income, right? And then after paying taxes, then it becomes earnings after taxes. Logically, it's very logical, right? It's literally earnings after taxes. And through this through this process and through these names, you also come to the realization that, earnings is just another name for profit. Yes, earnings is just another name for profit, right? Then you also wonder, But then we had, income, a big, total income, right? A big category, which is, gross income. And then and at this level, I mean, EBIT level, right? It's also called operating income, but actually, from this level, it's profit. From here, from here on, it's profit. But why do they keep calling it income? I mean, is income the same thing as profit? No, obviously not. Income is in gross context, right? It's in gross sense. Obviously, if you have a business, right? Um, Income means, primarily your sales revenue. Isn't that right? Sales revenue. Sales revenue by itself is not profit, right? You have to take out expenses, right? Then it's profit. So income is clearly a different thing from profit. But why do they keep calling this income? I mean, it should be called EAT. Another name for that is net income or net profit. So I don't like the word income to being used at these stages, right? The better term is operating profit or net profit or EBIT or EAT. But in accounting, this is all accounting thing. In accounting, they still call it net income and operating income. So this was, this looked so irrational and stupid and crazy to me. I'm not an accounting person. I'm an economist, financial economist, and from economist perspective, calling them income at this point, right? Unless it is gross income or total income, right? Calling them these are profits and still calling them income is almost like there's no principle. They don't seem to have any principle. But actually, I try to be generous and I try to be lenient to the accountants and try to understand them. And also, I see the context why they retain the term income here, right? Oh, then I realized, okay, this is why. See, if this is, of course, income statement is something you have for businesses, right? For businesses, they are certainly, operating income is profit, right? And then net income is net profit, right? For businesses, we call it profit. But what if this is an individual, not a business? What if this is an individual? In case of individual, it's pretty much the same with only a few, minor adjustments. If you think about it, for individuals, you have also two sources of income. Major source of income is your labor income. Isn't that right? Which is also called earned income, labor income. Labor income is like your sales revenue. Isn't that right? Is there anyone who can't connect these two? Your sales revenue is your labor income. Why? Of course, because you're selling your labor. Your salary is the result of selling your labor. Isn't that right?
Yeah, that
Does
makes
anyone
sense.
have? Yeah, of course. And you also have secondary source of income, which is investment income, right? Of course, if you have billions of dollars, if you are a billionaire, most of your income, your primary source of income will be investment income. But unless you're a billionaire, you will have to put in your work, right? Your honest, hours, like 8 hours a day, or even, extra. I mean, if you, the more hours you put, the more income, you will put more hours. Definitely. Right? Well, unless you're a billionaire, that's how it is. Your major source of income is, primary source of income is your labor income, which is your sales revenue. And then your expenses, you have fixed expense and variable expense, right? Your fixed
Quick,
expenses, you have someone was
Professor,
saying
quick
something.
question.
Yeah,
Yeah.
yeah.
Passive income would be considered, it is considered investment income as well, correct?
Actually, passive income would be a broader concept than investment income, because where does that passive income come from? I mean, yeah, investment income is a very good example, a very typical example of passive income. But if there is, let's say you didn't invest yourself, but let's say you have income from, let's say, let's say you got injured, right? You got injured. So from the, whatever reason, from traffic accident or, injury from work, there was a settlement, and there's, income from that settlement. That would be a good example of also a passive income, right? So in that case, that wasn't an investment, but it's a passive income. So I would consider passive income a broader umbrella, right? Makes sense. It's a broader category name um, than investment income, and investment income would fall under that umbrella.
Okay, so it's more of like investment income can be passive income, but not all of
Yeah,
passive income is
not
investment
yeah,
income.
yeah, exactly.
Okay.
Logically, cannot the reverse isn't true, right?
Okay.
Okay,
Thank you.
you're welcome. Um, so where was I? Yeah, and also as a as an income earning person, right? You would have um, variable expenses and fixed expenses. Fixed expenses would be your uh, uh, food, shelter, clothing. I mean, rent. Rent is pretty much fixed. Food, there may be some variations, some variance, but it will all average out to a constant number, right? I mean, uh, uh, um, for basic necessities, right? Expenses for basic necessities. Clothings, there may be some variance, but it will all average out to a constant, right? It's not like you suddenly have uh, some. I mean, um, you don't, unless particularly have a propensity for very fancy clothing, or unless it is for your vanity, pursuit of vanity, right? that's not um, that's not your fixed expense, right? If you're pursuing some vanity, right, that's not your fixed expense, right? Food also, I mean, you eat 3 meals a day, 3 square meals, that would come to a very fixed number, isn't that right? Three square meals per day, um, or 2 square meals per day, whichever, unless you have but otherwise, everything else. Look, oh, the expenses for dating, no, social life, no, that is not. Think about it. You can consider that as variable expenses, but they don't serve they don't serve to increase your income, isn't that right? Your social life doesn't necessarily, that's just for your own entertainment, isn't that right? Um, I mean, if you're living just like a business, I mean, consider yourself as a one man, one business entity, one single business entity. You wouldn't spend money for like uh, you wouldn't spend your expenses won't include some category like personal pleasure, right? Whatever you do for your personal pleasure, that doesn't help to increase your income, right? So you have fixed expenses, and you must have some variable expenses depending on let's say to do your business. I mean, you need some and variable expenses will increase or decrease with your income, right? Makes sense. You have to make a travel. You have to make trips to let's say you're a salesperson and you have to make trips. Those trips, number of trips will be in commensurate with the number of trips will be commensurate with your income, right? The more trips you make, more likely the more likely you'll make sale, right? So expenses, those are, of course, not all the time, you will be successful, but more or less, if the more effort you make, right? So those are direct expenses. And then, so let's say you subtract your variable expense and fixed expense from your income. Then you arrive at, what do you call that? You will arrive at EBIT, earnings before interest and taxes. But then, do you call that operating profit? Huh? I mean, you can consider that as profit, but for individuals, you don't call that profit. It's still income, right? So yeah, now then that makes sense why in accounting they still call it income. Uh-huh. I mean, because if you are as an individual, right, your salary is your income, and from your salary you pay rent, you pay taxes, you pay interest, you pay um, your fixed and variable expenses, and whatever is left, still you call that income. Net income, you call that net income, right? Not net profit. It's the same concept, but you don't call that profit because you're not a business, right? Makes sense? Uh, Now, so I used to call accountants inconsistent. Why do they or rather should I call them consistent? I mean, but there's no logic. Why is it still income? Why do they call it still income? Now after I don't call them uh, I don't call them stupid anymore because obviously they are not stupid people. But there is a reason why they still retained. Now I understand. There's a reason why they still retained that term income there. But for business, obviously that's profit, right? And another thing that we had a little debate last time was the concept of gross profit. Okay, and I've been telling you, gross profit is not it's incorrect, or it's not fully disclosing. It's not fully disclosing. Why? Because gross profit is not all of the gross profit is not the result of subtracting all expenses. And as I said, if the variable cost is very small, and if the fixed expenses, fixed cost is huge, right? Then it can be hiding. And just talking about the gross profit, it could be, due to an ulterior motive. They must be misleading you or trying to hide, true, profitability of the company. Yes, that's why I said, gross profit is not the true measure of profit. And true, but also this gross profit will be meaningful if you have a very minimal fixed fixed cost. Does that make sense? I mean, and all the businesses are trying to minimize the fixed cost because fixed, you have to, I mean, even if your business is not doing well, you still have to bear the fixed cost, right? Regardless of your sales revenue, right? During the bad economy, your sales revenue will go down. That goes without saying. But the fixed cost doesn't go down, right? Fixed cost doesn't go down. So you have to downsize to, but and downsizing is painful because you have to lay off people, literally and also physically downsize. The size of the plant, size of the business has to, go down. Laying off people is a very, a painful thing. I mean, it's not from the worker's end who get axed, right? Obviously, that's not. And then from the management's perspective, so because you think managements are owners of management is not the owner. Okay, sometimes they can be, small business management, small family-owned business, right? Owners are managers, right? But if it is a large corporation, owners and ownership and management are separate, right? Large corporations, owners are basically the owners are stockholders, right? And owners don't care about whether I'm I've been telling you I'm Apple shareholder, right? But my holding of Apple would be not even 0.0000001% of the Apple's entire ownership. And in a publicly held corporation, ownership is diffused, right? Ownership is diffused. Ownership is not concentrated, and so minority owners, minority shareholders are only very small fraction. That's why they are minority shareholders. And minority shareholders are anonymous. Actually, they don't know who you are, and I don't care if they know me, because my connection with Apple is only as good as the number of is only as much as the number of shares I own. That's it. You could be also an Apple shareholder, and you could also be partial owner of Apple, but you are an anonymous owner, right? But that's the nature of a publicly held company. So the owners don't care, what the owners care is only the maximization of their stock value. Isn't that right? What owners care about is the maximization of the stock value. As long as Apple gives me a highest return, maximum stock value, right? I'll be happy. And how they deal with the labor issue, right? That's the concern of the management. That's why the shareholders hire the management, right? You understand? The management is hired by the board of directors. Board of directors are the representatives of the shareholders, elected by the shareholders, right? Theoretically so. Although I'm Apple shareholder, I never got invited to Apple's general shareholder meeting, right? Annual shareholders meeting. I sometimes get invited by some funds that I hold, ETFs or but I don't know. they don't probably send out, a massive mail to every shareholder. Has anybody got any? If you have any shares, has anybody got ever invited to the general shareholders meeting? Huh?
No.
No, and I don't care. Yeah, I mean, if I really care, I must be a majority shareholder, don't you think? And if I were a majority shareholder, I must have been invited to the general shareholders meeting, and I will cast my vote. I don't have to be present there, and uh, I get those, invitations by mail, and I can vote by mail or, online. So I don't actually have to attend the general shareholders meeting, right? Some stocks that I own, I get those, mails, and I hardly can find time to vote. But what are they voting on? They are voting on the directors, right? And the directors, then decide, whether to hire or fire the existing management or not. Uh, you understand? What the board of directors do. The role of the board of directors is to hire and fire the management. If the management does, so management has, of course, sometimes the head of the board of directors is the chairperson, head of the board of directors. And chairperson is not necessarily the CEO, because CEO is the head of the management. And I've been telling you, management is hired people. They are not owners. They don't represent ownership. I mean, they work for the best interest of the owners. So their duty is to maximize the stockholder wealth. Okay. Of course, if you're hired as a CEO, then you are given CIO or CFO. You're also given stock options. So you become part owners as well. And of course, if you have a stake in the company, you would do your best to maximize the stockholder wealth of the company, right? So that's an incentive. I mean, why they give the stock option? That's an incentive, right, for these, management. But also, sometimes the chair also functions as a CEO as well. Of course, that's possible, because if you're the majority shareholder, you can, and suppose you have 15% of the shares. That's a huge amount of 15%. And if you have 51%, nobody can beat you. Your vote will dominate always. Your vote will prevail. But nobody has 51% of the shares. But you have friendly forces, right? You have friendly majority shareholder. If I have 15% and my wife has 11%, like Bill Gates and Melinda Gates, who are divorced now, but previously, and you're some big institutional investor that has 9%, so you form a pact. You form a pact with these friendly forces. Then you can reach 51%. And if all this 51% vote all together, right? And appoint you, vote for you to be the CEO, then you become the CEO too. So as that's what in the past, Steve Jobs was the chair and CEO of Apple, right? And in some and during the years when Apple was not doing well, 1990s, that was like 1995, through 2010 or something. There was a period during which Apple didn't pay any dividends because Apple was going through uh, uh, tough time. That was like 1995 through I believe 2010, and around 1995 the board of directors of Apple kicked out, fired Steve Jobs from CEO position. Okay, that sounds like then Steve Jobs was completely out of Apple. No, 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 no. Steve Jobs was still, a either chairperson or, even if not chair, he was one of the majority shareholders, right? So he was one of the directors. But that's ownership. That just means ownership. But, he was kicked out from the management. But until then, and then in 2010 or around that time, he got hired as CEO again, right? So what does that mean? Sometimes chairperson can double as CEO. So you think now, most of you think, if he's CEO, he must be chairperson too. He must be chairman and CEO. No, that is just a coincidence because Steve Jobs and like Bill Gates, they were both chair and CEO uh, at the same time. They served two functions, for a long time, and it's plausible because they thought, they all agreed nobody knew better about the company. Nobody knew how to run the company better than uh, these founding father, right? I mean, Microsoft was founded by Bill Gates. Steve Jobs and Steve Wozniak founded Apple. Who knew better about how to run the company? And they ran the company until up to a certain point, and they did it very well. So the board of directors kept them on management. But once the Apple faltered early 1990s, then they sacked Steve Jobs, and then Bill Gates wasn't always CEO. He stepped down as CEO around 2010 or something, and then I forgot his name. The was he George somebody, and he was CEO for a long time, and then he was really just the hired management. So anyway, the point is, uh, all these, think about it. Amazon.com is a good example of the company that tried to minimize the fixed cost, right? Because think about it. Amazon first started out as online bookseller. They sold, books and CDs online. So that they were direct competitor to Barnes and Noble. But the Barnes and Noble, what is the major advantage over Barnes and Noble? First of all, Barnes and Noble was a brick and mortar bookstore, so they had huge fixed cost because they had brick and mortar stores. Brick and mortar stores, every month they had to pay rent, right? And there are employees, in these, brick and mortar stores, and they had, these, outfits, these, brick and mortar stores, retail fronts, retail stores all over the country. So think about the fixed cost, right? They all had to bear the fixed cost. But then Amazon didn't have any storefront. They didn't have any physical store. It was online. All they needed was a central warehouse. So they cut down on, fixed cost a lot. So if think about it, all the businesses want to be lean in their fixed expense. All the businesses want to shut off the excess weight. Shedding off the excess weight is basically shedding off the fixed cost. If possible, they want to. So then, think about it. If your fixed cost is very minimal, yeah, then gross profit makes sense. I mean, gross profit could be a good measure of your operating income, operating profit. It could be almost equivalent to the operating profit, and there won't be that much difference between the two, right? That makes sense. But unless your business is like that, right? Unless your business has no or very slim fixed cost, right? The gross profit is not a good measure of your profitability, right? Does everyone make that? Does everyone make?
It makes sense.
Yeah. Okay. All right. All righty. So now next, I'm gonna. So this is a little extra. So once you arrive at EAT or net profit, right? Then that's not everything. I mean, that's your. Um, so who does this belong to? Hmm? Now, who does it belong to? Who does this net profit belong to? Hmm?
The owners.
Yes, the owners. And the owners are, I mean, in general, I mean, unless this is a sole proprietorship, right? Or family owned business, right? Um, uh, the profit belongs, unless it is so, right? Then, the profit belongs to the shareholders, right? And the um, shareholders are, as I said, many. Shareholders are many, belongs to the shareholders, and shareholders are many, and there are millions of millions of Apple shareholders, right? So then they say, profit belongs to the owners. So what do? They distribute this profit. Does Apple distribute this profit to the shareholders every quarter, every year? What do you
No.
think?
No,
No.
they pay them like interest.
No. Why interest? Interest is something they
Like
uh, dividends. Yes, dividends. Who said dividend?
and
Huh? Say that again.
Anna.
Anna. Okay, dividend. Okay, Anna. So I'm gonna give you 0.25 for that answer. Uh, Anna, 0.25. Today is 09 what? 18, right? Um, they pay dividends, not interest, because interest is something you pay to the lenders or creditors, right? Or debt holders or bond holders, right? They all mean the same thing. Debt holders, lenders, creditors, bond holders, they all mean the same. Uh, you don't. Owners are owners. Owners who are the those who provided the equity capital. I mean, literally, the company owners didn't lend money, right? So it's not, interest. But then interest Yeah, but they pay dividends. Dividend is only a small fraction of the profit. Okay, so they pay out dividends, but dividends are not an obligation.
Professor?
Okay, yes,
So for debt, they
for
pay
a what?
interest. For debt, they pay interest, and then they pay
For
dividends
equity,
for equity. Yeah.
they pay out dividends.
Okay.
Um, and the dividend is not an obligation. Oh, think about it. Interest is an obligation because somebody lended you money, right? So paying out interest is an obligation. If you don't pay out interest, then uh, they can that is they can sue you for right, obviously, because it was a breach of contract, isn't it right? It's a breach of contract. um, but dividends are not an obligation because if I'm the owner, right, whether I get my dividend or not, it doesn't matter because anyway, suppose this is a family owned business or one sole proprietorship, one man owned business. Whether I pay dividend or not, it doesn't matter because anyway, that belongs to me, right? That profit belongs to me. So it's not an obligation. But it's not. It's publicly held. It's not, sole proprietorship. It's not family-owned business. So how does look? Uh, as if I own 100 shares of Apple, if I want my profit, if I want to recoup my profit, what do I do? Hmm? If I want to recoup my profit, what should I do? No one?
You sell?
Yeah, of course. Yes. And who was that?
Anna.
Anna. Another 0.25. Yes, you sell. You simply, um, ah, Anna, where have you been? Huh? I
I'm
mean,
here.
I know,
I've been
I
here
know,
since the
I
beginning of
know,
now.
I know. You are also taking Finance 300 with me now this semester, right?
Yes.
Yeah. And who did you take Finance 100 with?
Finance 100. He's that professor. You mentioned him last time. I forgot his name.
Adamu? Nicholas Adamu?
Yes, him. Yeah.
Yeah, well, I can always count on Nicholas. He's a very good colleague of me. I can always count on Nicholas, and he really taught you well. And when I say where have you been, I'm just it's a it's a metaphor. I mean, where were you when I taught FNB 100? Huh?
Oh, I don't know. I never
You,
saw your name
of course,
come up on.
where were you? I mean, why didn't you take FNB 100 with me? But you took, you did well. I believe Nicholas taught you well. Um,
Yeah, I also took it a while ago, so I don't know if you were
mm,
in
mm.
the MCC.
Um, so anyway, you can simply, if you want to, if you are, just a minority shareholder, and if you're a minority shareholder, and if you want to get your profit back, recoup your profit, all you need to do is just sell, sell those shares, right? And how does that recoup? If this company's profit is let's say $1 million, right? If this company's profit is $10 million, let's say $10 million. And this company's equity, total equity, the market value of their stocks is, $200 million, $200 million now. But when you bought the stock, I'm sorry, let's put it this way. So this company's profit is $10 million, and the equity was previously the market value of the equity previously when you bought it was $100 million, 100 million. That means and there were 1 million shares outstanding. So let me write it down here like this so that you can. Oh, no. Oh, small. Oh. Okay. So let's say equity at time 0. Equity at time 0 means market value of stocks. Total market value of stocks was 100 million. And the number of shares outstanding it's hard to write this. Not dollars, it cannot be number of shares, so not dollars. And from this, what can you say about the price of the stock at time 0? What should be the price per share? What should be the price per share at time 0? Anyone?
100 million divided by 1 million.
Yes. And who was that? Who said
that? That was Richard.
Richard, okay. Yeah, that's just simple as that, market price of the stock at time 0 is, then $100, right? 100 million divided by 1 million shares, so $100. Now, and then your EAT, or net profit, 1 year has passed, right? The company has operated for 1 year. So from time 0 to time 1, right? So obviously your profit will be measured or evaluated at the end of the year, right? Time 0 is the beginning of the year. Time 1 is the end of the year, right? End of year 1. And EAT is $10 million. And then what would be then the value of the equity, or market value of total market value of the stock at time 1?
So do we multiply it or divide it again?
No, you tell me. Divide or multiply what?
Do we multiply the 10 by 1 or divide 10 by 1?
No, you decide.
Okay.
You have to give me that answer. Not, but here they're simply, 1 year ago, total market value of those stocks was 100 million, and during the year, right, at the end of year 1, the profit of this company was 10 million. And now what should be the market value of total market value of the stocks, or otherwise, equity at time 1? What should be the value of equity 1?
10 million.
10 million? 10 million is only the profit at the end of year 1. Come on, guys, think about it. Equity is what? Equity is basically owner's capital, isn't that right? Equity is the owner's capital. So equity belongs to the owners. Equity is basically the total value of the stock. Isn't that right? Because the owners paid in, the shareholders paid in this 100 million through holding 1 million shares. Right? Isn't it right? And then I own 100 shares. I own 100 shares. 100 is only 0.1% of 1 million. I mean 0.01%. Isn't that right? But there are like thousands of shareholders like me, so they chipped in all, and at the time we bought those shares, it was $100. So 1 million shares make 100 million. 1 year later, the company made profit of 10 million. Who does this 10 million belong to? Who does this 10 million?
The 1 million shareholders?
Yeah, to 1 million shareholders. I mean,
So then do you divide
look,
it again by a million?
number of shareholders are not necessarily 1 million. It's just number of shares, right? There could be 1,000 shareholders, but yeah, you got the idea. Holders of it belongs to the holders of those 1 million shares, right? Okay. There were some voices, so if you had a question, please ask me now. You had a question? What was your question?
So do you divide the 10 million by the million shares again?
But yeah, that's one thing you can do, but that's not my question. That wasn't my question. If you divide this 10 million by 1 million shares, then that's the profit belongs to each share. That's simply, if you divide it by 1 million, is called, earnings per share. Okay, but that's not what I asked. My question was, if you divide it by, 1 million, then it's called earnings per share. But that's literally, that's called earnings per share at time 1. But that's literally what it means. earnings. This is earnings after taxes, right? Earnings per share. You divide it by number of shares. So per something already means per something, or it already means always when you say per something, that's an average, isn't it right?
Yeah.
Right. So yeah, you can do, to find earnings per share, then you divide this by 1 million. But that wasn't my question. My question was, what is equity? What is now the total value of equity at time one? And I just, I told you this 10 million belongs to the shareholders, the owners, right? Equity is something that belongs to the shareholders. Then what should be equity at time one?
So it would be the 100 million plus the 10 million.
Yeah. Exactly. It is then 110 million. Isn't that right? Equity is, basically capital that was raised by the shareholders, capital that was raised and invested into the company by the raised from the equity holders or shareholders or the owners. That's called equity. That's equity. And it's called paid in capital because this capital is paid in. Equity is basically paid in capital. And then profit belongs to the owner, so it's a kind of equity, but this is not paid in capital, paid in equity. This is internally generated. This is internally generated equity from its operating activity, right? Operating activity. So yes, it's 110 million. Then think about it. What should be the share price at time one? What should be the share price at time one then? What should be the share price at time one? You are able to arrive at 110, huh?
110?
110. Yes. Who gave me this 110?
Anna.
Who gave me this? Huh? Anna?
Yeah.
Okay. Anna, you gave me also 110 million too, right? Wasn't that you
Yes.
who gave me 110? All right. So
Yeah.
you got 0.5 for both answers. Yeah, now think about it. Yeah, this is as simple as that. If the company's total stock value was 100 million, and if the company made, so then the stock price, equity, original total value of equity was 100 million, and if there are 1 million shares outstanding, stock price must be exactly 100, right? And then if the company made 10 million during the year, right? At the end of the year, of course, this is something you can, calculate at the end of the year. Then that is added. That's the internally generated equity, internally generated from the operating activity of the company, and then equity at time one will be 110 million. Okay, and then stock price should be 110 million divided by 1 million shares, and it's going to be $110. So think about it. If you want to recoup that profit, you sell. And then you sell it at $110, but you bought it for $100. So what did you make? Your profit is exactly $10 per share. You exactly recouped the profit that belongs to you, right? If you want to recoup your profit, you sell your holdings of your stock, right? If you had 100 shares, this would be times 100, 1,000, right? Also think about it. This 10 million is net profit, or called EAT. And if you divide this by number of shares, right? I told you that's called earnings per share. And the earnings per share is exactly what? Earnings per share is, divide 10 million by 1 million. Isn't that exactly $10? Right? So if you sell the stock at the new price of 110, which reflects the earnings per share, you recoup exactly earnings per share, which is the profit per share. Right? So they all fall into places. I mean, this is all logical. Okay? And some people might ask, well, what if they sell new shares, during the year? I mean, don't they will this number remain the same? Unless they sell new shares. This number will remain the same, because if the company issued 1 million shares at time originally, and number of shares don't change, number of shares outstanding don't change, because it's always in the primary market they sold 1 million shares. I talked about the difference between primary market and secondary market, right? You guys remember primary market and secondary market? Primary market is the first round of sale of stocks. So in the primary market, the stocks change hands directly from the company to the first round of buyers, and after that is called secondary market. And in the secondary market, it's only the transaction between the investors, buy and sell, buy and sell. So the original number of shares don't change; it's still the same. And what if the company sells new shares? Then the stock price will be diluted if the company sells another 1 million shares, as long as they can sell at $100, then the price won't be diluted. But if if there are 2 million shares, and if there isn't demand for 2 million shares, then price will go down and the price will be diluted. And because of that, they don't do that, because shareholders suffer from the dilution of the stock price, right? They don't want the company to sell new shares. Okay? And stockholders are the owners. Board of directors are the representative owners. Board of directors don't want to do that, right? So the company doesn't sell new round of shares. They can do that, like 10 years later, after sufficient time has passed, and if there is enough pent-up demand for the shares, they're not selling new shares, every day. They can't do that. So the only reason the number of shares outstanding will change are only two. There are two reasons. One, if the company sells new shares, but that hardly happens, because no stockholder wants their stock prices to be diluted. Second is when company buys back shares, buyback. But otherwise, no. So that's how this can this, even though this is a simple illustration, this is the logic behind it. Okay, Now the time is 10:41, and I think this is well past the time for our 10-minute break. So let's take a 10-minute break now and reconvene at 10:51 or 10:52. Okay, all right. So let's take a 10-minute break. All right, we're back. We're back. So, so we were talking about actually, how the profit can be recouped, right? If you, because the profit belongs to the owners, uh, but company doesn't distribute the profit directly to the owners. But then how can a shareholder recoup the profit? Simply you sell it, right? Then you recoup that profit, which is the earnings per share, which is the increased, reflected in the increased price of the stock. Now, so as I said, dividend is what company pays out from that uh, uh, EAT. In other words, companies generally don't need to pay out. I've been telling you, uh, dividend is not an obligation. Uh, it's a small fraction of the profit that they pay out to the shareholders as a token. It's a token of, it's a signal basically. It's a token that the company is making profit and you can partake in it. You can partake in the profit. But so actually paying out dividend is not a big deal because if whether you get dividend or not, whether the company pays out dividend or not, if you want to recoup it, you can just simply sell and you can recoup it. And dividend is a small fraction of that profit that it will be paid out as cash. So after, so this can be zero or a positive number. So after subtracting after subtracting dividend from the net profit, right? Subtract the dividend from EAT or net profit. What should it be called then? The result. I'm going to have to because this is everywhere. Okay. Anyone? After subtracting dividend from the net profit, what is it called? What's the what remains? What's it called? Anybody?
Interest after taxes.
No. Why interest? I mean, interest is something that the company pays out to the debt holders, right? Interest is something they pay out. Interest after taxes. And first of all, there can be no interest after paying out taxes. Taxes were already paid out. I mean, we are here because we have already paid out interest and we have already paid out taxes. We are, we are at the final
destination.
stage of all the process. So from the profit, you paid out dividend. So whatever is left is called what? Anyone? I hear some noise, microphone noise, but I don't hear anybody saying anything. What is
Profit?
Isn't
huh?
it retained earnings?
Yes. And who was that?
I said two.
I said to. Okay. I said to. Okay. You're getting 0.25 for that answer. Yeah, it's called retained earnings. I mean, the terminology is if you carefully and closely look at the terminology and interpret it, and most of you who are not used to interpreting anything, I mean, oh, English is my first language, I'm an American, English is my native language, what do I need to translate, what do I need to translate it to? I mean, to what language? No, interpret doesn't mean. But people who whose native language is not English is used to translating and interpreting it. But think about it. You don't read just because you can read it doesn't mean, I've been telling you, just because you can read it doesn't mean you understand it. That's why there's a expression like reading comprehension. You read it and then you must comprehend it. And if you can comprehend it, now, if you know what interpreting means, I mean, English is my mother tongue, what do I translate to? What do I interpret it for? What do I interpret it for? Interpreting means you reflect on the meaning of the word. Reflect on it. And then you can tell, literally, the word means what it means. It's the profit, or I've been telling you, earnings is another name for profit. It's the profit that was retained. Retained means, dividend is paid out to the, so it's out of the company, right? Dividend is paid out. And after paying out dividend from the EAT, or net profit, this is what's retained within the company. This is the profit that's retained within the company, right? So what else can it be? What else can be the name for it, right? Some, nonsense came up, along the way. But, if you think correctly and logically, if you just think logically, there can be no other conclusion. That's what it should be called. It's called retained earnings. So retained earnings, so what do they do with the retained earnings? Does the company just, sit on it? What do they do with the retained earnings? Anyone?
Maybe they can invest to produce more money.
Say that again.
Maybe they can use that. They can use the money for a future investments or for make investments.
Yeah. In other words, they reinvested into the company's expansion, right? They reinvest. Come on. This is. Let me stop this. They reinvested, right? They reinvest. Reinvesting means, company needs to grow. I mean, who doesn't want the company to grow? Growing means, the company's production capacity will double, or, company's production capacity will grow. But growth of the company's production capacity cannot come without, a capital that is, used for acquiring new equipment, acquiring the funds are needed. There are the capital that was retained will be used to hire a construction company to build new plants. And with the new plants, their production capacity will grow. And when their production capacity when their production capacity grows, then their output, the production level will grow. And as their output grows, with more output, they will cater to more customers. They will cater to more customers. And as they cater to more customers, their market share grows. Isn't that right? More customers means more market share, right? The more market share, you become more dominant player in the industry. And the more dominant player in the industry, the more revenue, more sales revenue, the more sales revenue, the more profit. The more profit, the more retained earnings, the more retained earnings, the more reinvestment, the more reinvestment, the more growth, and the more output, and the more output leads to more market share. More market share means more revenue, etc. And it's a cycle, right? Does that make sense? Okay. And who said reinvest?
Janet.
Janet. Okay. Is Janeth with TH, not T, right?
TH, correct.
Okay. So Janeth. Okay, you got 0.25 for that. Yes, that's what it's being used for. So it's also called plowback. Retained earnings, also called plowback. They plow back into the company. Plowback. Okay. Actually, I think I should move it here. Reinvesting is plowing back into. All right, so that pretty much that pretty much is the everything that we can talk about as when income statement is concerned. We got to move on to the balance sheet. But before we do that, let me point your attention to the assignment. Everyone knows that the homework was issued on September 4th, right? Right? Everyone is aware of that, right? Class protocol here. Maybe I should just homework 1, right? And I just sent out another reminder, right? Homework 1. Please exactly stick to the instruction, right? You must name the file exactly like this, and then it's due. That will be next Saturday, isn't it right? It's 18th today, so it will be next Saturday, by the end of next Saturday. And then I also gave a further instruction. Okay, so everyone is aware of that, right?
Yeah.
Okay, good. So you should have got started already, because it was already posted on September 4th. You should be at least halfway through by now. And where is okay? So now let's go to the balance sheet. And at the beginning I told you balance sheet and income statement serve two different purposes. So all their line items are all different, right? The only thing that is common to them would be depreciation. Otherwise, all different line items. And the goal of the income statement is uh, to describe the process leading to profit or loss, right? Profit or loss. So also, income statement is sometimes called a P&L statement, P&L or P/L. What would that mean? What would P&L mean?
Profit or loss?
Yeah, profit or loss, right? But yeah, so a profit or loss is the ultimate conclusion of the income statement. And also, income statement is also describing the operating activity. What is the operating activity? Operating activity is from this point to this point, arriving at operating income. In other words, where the income comes from, right? Where are the what are the expenses? Subtracting expenses from income, then you arrive at operating income. And so the operating income is the conclusion of the operating activity. Operating activity is nothing but, yeah, all the companies must sell something and generate income from sale of something. And then they must subtract the expenses and must arrive at operating income. And hence called operating income because it's the result of the operating activity. Excuse me. Now, and then, so goal of the income statement is the profit, right? But the goal of the balance sheet is not the profit. The balance sheet exists to describe the capital structure. Capital structure. Okay, then what is capital structure? I think I will need to. Okay, that. I will need to erase all of this. I will need some space. Um, so what is the capital structure? Capital structure is nothing but the proportion of equity and debt, right? Proportion of equity and debt in the total assets of the company. Okay. So in this example, right? In our example, okay, what is? Oh, I'll get rid of. So if you think about this example, right? You see, the first part of balance sheet is the asset part, right? And the total assets, you see the total assets there. And then the other half is the other half. Normally we put it on the generally they stack it up vertically, but it's easier. It will be pedagogically more amenable. It's pedagogically more easier if I put it side by side. But I will just keep it this way because I need some space to write. I think someone. If you have a question, please speak up because I will have to. Is there a group chat? Oh, okay. That, so I talked about equity and debt a lot as I was talking using the um, as I was talking about income statement. Um, so let's take a look at the liabilities and equity side. Basically, the liabilities and equity side is all about uh, liabilities and equity side exactly breaks down into liabilities section and equity section. Okay. You see, here is the liability section, and then here's the equity section. So I should have actually let's do this. Okay. And then in the asset side, right? Asset side breaks down into current assets and non-current assets. So actually, I would say okay. I gave a space here, which wasn't necessary here. Forgot. So first of all, let's take a look at the non-current asset because um, uh, asset breaks down into current assets and non-current assets. And what is non-current asset? Non-current asset is the really the bone and knuckles of the business, and especially if you are a manufacturing business, right? Um, if you are a manufacturing business, non-current assets are the foundation. Why? First of all, non-current assets are called also real assets. Ah, I better write it. Okay, real assets, also called physical assets, or fixed assets. And think about it. Suppose you are starting up a manufacturing business, and I think we assumed in the previous class, we assumed something like a mouse, right? Wireless mouse business, wireless mouse, manufacturing. Of course, you won't be only doing wireless mouse. I mean, if you are in that, if you are capable of, manufacturing wireless mouse, you would also be capable of, manufacturing like keyboard, wireless keyboard and things like that. So let's say computer peripheral in that business. Now, the first thing you need is clearly, first thing you need is the plant. Without plant, plant and equipment is the biggest thing, right? If you think about it, plant and equipment is the biggest thing. It's I listed it as equipment, plant, and property, but the better classification will be plant and equipment, building and land. Okay, plant and equipment and building and land. Now, so suppose you need, ignore these numbers. Let's say you need, $20 million. Let's say you need $20 million for plant and equipment, land and building, right? And without, this is the initial startup capital. I mean, you will need more than this because this is barely the minimum for your physical assets, right? Plant and equipment, building and land. That alone, you need 20 million. But just because you have 20 million and you spent it for plant and equipment, building and land, it doesn't mean you can start the production right away. You need some operating capital, right? You need some capital. You need some capital to support your to support your business until you put out your first batch of products and sell them and generate revenue from selling them, right? So the non-current assets are simply the total capital you need for your physical assets, right? And then the rest of it is, let's say you need 10 million more, and those 10 million is the operating capital, right? In other words, something you need to support your business, right? Until you make your first sale, right? So then the total will be 30 million, right? Total will be 30 million. Let's say that is that's your total assets. And then question is, how would you raise those 30 million? And there are only two ways. I've been telling you this over and over. It has to either come from owners, right? Or from the lenders. If it comes from owners, it's called equity. If it comes from lenders, it's called debt or liabilities, right? So this 30 million breaks down into, so it would be a combination of the two, right? Not all the, not even a single company is 100% debt free. Apple used to be 100% debt free. Apple used to be, because Apple didn't need to borrow money. There was already equity raised by selling stocks was already good enough to fund their plant and equipment and everything. But even Apple, starting from 2012, they started to sell bonds. They started to raise debt capital, not because they needed debt, but because they simply because interest rate was so low. Interest rate is still low. The benchmark rate, the Fed funds rate is just about 0 to 0.25%. So it's so cheap to borrow money. And what did happen? They didn't borrow money to build plant and equipment. They borrowed money simply to put it into the stock market, right? If you can borrow at like 0.25% and put it into the stock market, and on average, if you get 20% annual return on average, wouldn't you do that? I make 20% return from the stock, and then I pay only 0.25% for interest. Well, I still get 19.275%, right, from this stock market return. And I didn't do it using any of my money. I simply did it with the borrowed money. I paid all back and pay 0.25% interest on it. I still have 19.75% return on it, right? Does everyone follow what I'm talking about?
Yeah, I'm with you.
Yeah, good. Apple did that. Apple didn't need to borrow money, but Apple did borrow money. They had no reason to, but Apple borrowed money in 2012, and they put it into the stock market. They borrowed almost at zero cost. So every company has, a combination of equity and debt, right, to raise this 30 million. Okay, and this 30 million is 30 million breaks down into non-current asset and current asset. And non-current asset is mainly the physical assets. And the current assets are liquid assets. They call this, liquid assets. Liquid. Okay, so liquid means, it can easily turn into cash, right? So think about it. What is liquidity? Liquidity is basically how easily you can turn any asset into cash. That's liquidity. So if you look at the balance sheet, asset side, it's also, a liability side as well. The line items are listed in the order of liquidity. in the order of liquidity, right? So cash and cash equivalents are most liquid assets. I mean, cash is already cash, right? And cash equivalents are basically, very very liquid short-term debt, like, uh, uh, 3 month, 1 month treasury bill, 3 month treasury bills. They are very safe, zero risk. Uh, Short-term instruments. So they are, and they bear interest. They pay interest. So they are very safe and very liquid, short-term, because they are easily sold. You have, while you hold them, they pay you interest, and when you sell them, it can be easily sold. So it's almost like cash. Accounts receivable. Accounts receivable are actually, I didn't break this down very much, but um, I should break it down into promissory note and accounts receivable. But uh, let me uh, let me do that here. And people easily understand what accounts receivable are. I mean, the semantics is quite obvious from the semantics. It's something that you haven't received, right? So something that you will still need to collect. So what does that mean? This is your sale. This is part of your sales revenue, but uh, the you didn't this revenue was not in cash. You didn't receive cash, but you receive, it's a either promissory note, or you receive, or this was a credit sale in a simple way, right? So accounts receivable. Let me. This looks like. So let me separately put accounts receivable. They are mainly credit sale. So uh, so make a clear distinction. This looks like 10. This 10 million is credit sale. No, no, no. 10 million is the total of the uh, uh, current assets. So is there a better way of? Maybe I'll move it up like that. Um, so part of one of the promissory notes. Promissory notes. Yeah, one big part of the accounts receivable is promissory notes, and the other one is, I'm gonna get to that. So if you promissory note is what? It's an literally, it's a promise to pay, right? Literally, it's a promise to pay. So it's an IOU, but then this is only between business to business. This is something that is being used only between the businesses. Um, you can write a promissory note, but you cannot use it to think about it. You can write a Can you go to an Apple store? You go to an Apple store and buy iPhone 13. I don't know how much iPhone 13 is, but let's say it's $1,000. Can you pay $1,000 in promissory note? You write a promissory note. I owe you $1,000. Will Apple Store
No.
accept it?
You
No,
have to
not at
pay
all.
right away.
Huh?
I said you have to pay right away. You
You
have
have
to
to pay
pay in
what?
cash right away, the iPhone.
Or yeah, you will have to pay with cash or um, uh, with credit card or with your check. Um, well, of course, nobody. I mean, Apple Store. I don't know if they accept personal check because you have a default risk. I mean, if you in the old days, people when they write a check, they used to they had to do the uh, like background check or whether the check will bounce or not. They will have to first check it. Um, if it is a small amount, they would take it, but personal check is really, really, questionable because uh, in the old days, I remember even in the 1990s, if you go to a restaurant, they used to have, the bounced check on display on the wall, right? In the diners in the 1990s. Uh, and of course, nobody, I don't think, they pay with check anymore uh, in the diners anymore. Um, but the idea is, but between business to business, right, in B2B, they use, IOU, which is a promissory note. And the promissory, because in B2B, they can, all the businesses have credit ratings, right? And the companies can easily check, uh, the credit ratings of other companies, uh, and if you have been doing, and unless you are a very uh, iffy company, I mean, unless you are a very questionable company that hasn't been around, I mean, you've never heard of this company, and in this industry, if you have never heard of that company is obviously quite new or very questionable. And usually you don't do business with questionable business, right? Questionable company. And even if you do business, I mean, you have to make a sale, you have to sell your products. And if this company is a new company, it doesn't necessarily mean that this company cannot honor their payment and promissory note. Um, you can run, before you do business with them, you have plenty of time to run, the background check on them, right? It doesn't, take that much, time to run background check. Um, but the benefit, now let's think about it. From the seller's perspective, it's not good for sale. It's not good for your business to turn down any buyer, right? That goes without saying. And if you have been in business, you know pretty much everybody in the industry. I mean, who's your competitor? Who is your partner? Who could be your partner? Who could be your supplier? Or who is your buyer, right? And who, most of all, who is your competitor? And all these things are, if you have been in business, you know. And you won't be, your business, your buyers will be, your buyers are the, known companies in the business, and you will take their promissory note. So promissory notes are actually not much different in physical look. In physical look, they look pretty much like a check. The only difference is that they have two things are different from a check. One is that they have maturity, meaning that this is a deferred payment, isn't it right? Because it's a credit sale. So you're writing a promissory note because you want to defer the payment. So the promissory notes have maturity dates, right? On the promissory note, they put maturity date. Usually this maturity date is, 30 days or, 60 days at most. Although theoretically it can be up to 270 days, right? Nobody will take a promissory note that will be paid in 270 days, right? Nobody will do that. So usually it is, collected. Promissory notes are usually collected within 45 days, and so the maximum maturity is like 60 days. So promissory notes are, and then a second feature that makes it different from a check is that it carries interest, right? It carries certain interest rate. Why? This is one way that will facilitate the acceptance of promissory note. Now think about it. Between the buyer and seller, right? And I'm talking about B2B. This course is about corporate finance, so we're talking about B2B. You must forget about B2C. We're not dealing with individual customer, right? We are basically a manufacturer, and to a manufacturer, the buyer is a retail business or a wholesale business or retail business. You understand? So we are in B2B. And also, if you're a manufacturer, you are a customer, you are a buyer, a customer to the parts and components manufacturer, right? A supplier of parts and components. You understand? You can be both, seller and buyer at the same time. And now think about it. Between the buyer and seller, there can be four payment modalities or payment methods. Isn't it right? In business to business, there can be four different modalities, four different modes of payments. You understand? What can you first think of? Anybody? What can you first? What is the first mode of payment? How do you
Debit
pay?
card or a credit card?
Say it again.
I said a debit card or a credit card.
Okay, a debit or credit card. Yes, of course. And who said that?
I said to.
I said to. So I said to. I give you another 0.25 for that. And what else?
A check.
What else? A check. Yeah, a company can issue a check. Who said that?
I said to.
Okay, so I said so you got another 0.25. And what else?
We're talking about business to business, right?
Yeah. Business to business.
Promissory notes.
Yeah, promissory notes. But that was already, yeah,
And
but
cash.
and who's, yeah, cash. Who said that?
Anna.
Anna. Okay, Anna. You said promissory note and you said cash, so I'll give you 0.5 for, uh, look, yeah, there are four modalities, four modes of payment. What it's quite obvious. You can pay with cash. Cash comes first, right? And from the seller's perspective, let's put yourself into the seller's position. As a seller, what do you prefer? I mean, among these four modes of payment, which one do you prefer the most? Hmm?
Cash.
Cash. Is
Cash, of
king.
course. Nobody can beat, nothing can beat the cash. Cash is cash. It's the most liquid asset and it's already cash. You don't have to wait, right? But what would be the second? Cash is the most preferred. What's the second preferred?
Debit.
Yeah, debit card. Debit card or debit, yes. And debit card is almost like a check, right? So debit card or check, right? And debit card is, of course, faster. Checks generally clear. Checks generally clear within 3 days. It doesn't take. And when I deposit the check, it will already increase my balance, right? If the company sold $1 million worth of products and received $1 million company check and deposited, it will already it won't be available balance, but it won't be available balance. It will, but it won't be immediately available, but it will increase my balance, right? By 1 million. And it won't take more than 3 days, to clear the check. So debit card or check. And what would be the third? What would be the third preferred?
Credit.
Credit card. Yeah, because credit card, I get paid already by the credit card company. So maybe, from the seller's perspective, debit and credit card are pretty much the same, and so it's the second, preferred, debit card, credit card, and check probably third preferred because the if I deposit the check, it may take up to 3 days for the check to clear, and then the fourth preferred, the last preferred will be. The last
The promissory note.
Promissory note. Yes, promissory note. Yeah. Why? Because promissory note can take up to 60 days, right? So if from the seller's perspective, in the order of preference is cash, and then debit or credit card, check, and then promissory note, right? If the maturity date on the promissory note is 60 days, then that means you will have to wait 60 days and you can collect, right? From the company, from the buyer, the company that issued it. And then from the buyer's perspective, what will be the order of preference? What will be the order of preference?
I think will be the opposite.
Exactly. It will be exactly the opposite, right? And who said that?
Janet.
Janeth, okay, I'll give you 0.25 for that. Yes, it will be exactly the opposite because from the buyer's perspective, promissory note will buy you the most time. Your cash doesn't have to move, right? Your cash doesn't have to leave you immediately. It will be so. And from the buyer's perspective, then cash will be the least preferred form of payment, least preferred mode of payment because then the cash leaves you right away, right? So then buyer wants to prefers to use promissory note, and the it will be the most. Then the seller will be reluctant to take the promissory note, right? So then because if I receive cash, $1 million cash today, let's say I received cash, then I can put it in the bank and earn interest for 60 days at least, right? Why 60 days? I mean, if I receive the promissory notes, then I will have to hold it for 60 days and I will forego the interest, right? I will have to forego the interest that I could have earned. Isn't it right? So then to entice or to encourage the seller to accept promissory note, then what does that mean? I will have to pay, the buyer will have to pay some interest, at least something, some interest to compensate for the interest that the seller would have to forego if they accept promissory note. So theoretically, um, uh, I would have, if I'm the seller, I will have no incentive to accept a promissory note if the promissory note doesn't carry the prevailing market interest rate. You understand? Does that make sense? If the promissory note doesn't pay at least the market interest rate, there is no reason to take the promissory note. Right? Make sense? Everyone.
Yes.
Yes.
Yeah, okay. And from the then from the buyer's perspective, if I pay market interest rate on my promissory note, then there's no point for using promissory note because the the minimum I can earn, let's say $1 million, I postpone payment, I defer the payment for the next 60 days, then the reason for that is because in the next 60 days, I can use this money and make a return that is at least something greater than or at least equal to the prevailing market rate. And of course, if I can only earn the market rate, which is the rate if I, that's what I can earn if I keep my money in the bank for 60 days, right? If I can only earn that, there's no point in paying exactly the market rate to the seller through the promissory note because then there's no point in doing that. So the reason I'm doing this, so the reason I'm paying with a promissory note is because I'm sure I can make a bigger return, higher return with this $1 million over the next 60 days, so that from that return I can pay the market rate on my on the promissory note, and I can still have something left over, right? So that's the reason why they are preferred to pay with promissory note, because they can at least they have an opportunity, investment opportunity, that they can earn from which they can earn higher return than the prevailing market rate. So that's the reason the promissory note carries interest. Of course, and that's the reason why they use promissory note. Okay, so clearly, accounts receivable represent credit sale, and some of the credit sale is because the buyer issued promissory note, but there are credit sales that were that credit sale that was generated by or initiated by the seller. Okay? In other words, look, promissory note is the credit sale that was actually initiated by the buyer, if you think about it. Isn't that right? Promissory note is the credit sale. I mean, the seller didn't want to receive the promissory note. They wanted to receive the cash. But if the buyer pays with promissory note, seller doesn't have a choice. It will have to be a credit sale. So promissory note is a credit sale initiated by the buyer, and a seller doesn't want to turn it down, because if the buyer is a big industry giant, and suppose we are a company that makes computer peripherals, like wireless mouse, and the buyer is the Dell, computer manufacturer like Dell. It's an industry giant, and if we don't want to rub them in the wrong way, you understand? As a small manufacturer of computer peripheral, we don't want to upset the industry giant, right? So we can't say no. We will accept the promissory note. So this credit sale was initiated by the buyer, but sometimes the seller initiates this credit sale. Okay, seller initiates the credit sale. And why and how? Now this it took longer than I expected, because today I wanted to go over some examples of the problems so that you could, but this is how it is. And the class is until 12:15, right? I thought I would take a break about this time, but then class is until 12:15, so I will have to go on without taking a break. I just thought the class was until 12:30, but no. So what is when is the what is the circumstance? What is the circumstance under which the seller initiates the credit sale? Huh? I'm gonna give this to you straightforward, because it will take too much time if I wait for your answer. Now, sometimes think about it. If I'm a wireless mouse manufacturer, I'm a supplier to Dell. Isn't that right? If I make computer peripherals, I'm a supplier and a vendor to a computer manufacturer like Dell, right? You understand? And if I make also, if I'm a manufacturer of like keyboard, or let's say inside a computer, the components that go inside the computer, if I'm the manufacturer or supplier of that, I'm a client. I'm a supplier to my client, which is an industry giant. And usually, these parts and components, manufacturers do not buy them, every time. They don't buy them. They don't shop around every time they produce. They make 1,000 computers or 10,000 computers. They don't go around and outsource this, every time. You understand what I'm saying? It's not like going grocery shopping. Grocery shopping, you go, you go grocery shopping, whenever you like, and then you're under no obligation to buy from one store, right? You can just shop around. But in manufacturing, you need to have a steady supply of parts at a constant price, because if you do that, if you shop for parts every time, you can't guarantee that you can get the parts, all the parts needed, and there's no guarantee that the price will remain the same. So what do? They sign the long-term supply contract, right? So you select a supplier. Of course, you will have to do do the research, or from the past business, business experience, right? With some suppliers, which supplier makes the best part, and which supplier does it with a competitive price. So you will write a contract, supply contract. You'll write up a supply contract, and from the supplier's perspective, it's also in their best interest, because they can, if they have a long contract with a manufacturer like Dell, they will have steady stream of order, right? So they won't have to work diligently. I mean, they will work diligently, but what I'm saying is they won't have to go around trying to sell their parts. And it's not like, think about it, all manufactured goods, they will have to produce on a manufacture on a massive scale, and they cannot produce on a massive scale without pre-order. Think about it. You make, if it is wireless mouse, you cannot make 1 million pieces of wireless mouse without any order, because without order you made 1 million mouse, and if you can't sell them, right, nobody buys them, or you cannot sell all of them, then you're deep in loss. So think about it, especially parts that go into computers, something like electrical parts, and chips, memory chips that go into it. I mean, those are not. They have to meet specific technical specifications that are tailored to fit certain model of certain manufacturer, certain computer models, made by certain computer manufacturers. So they will have to make it, the parts and components that are for computers will have to be made, ordered, like custom ordered for a particular model. Or even if it is universal part, still if there is no order, just making them without any order will be a senseless thing. So if they have a contract with a big manufacturer, that means the steady stream of business for this small company. So under the supply contract, and the supplier contract is usually for about 2 years, or sometimes it can be 5 years, but usually about 2 years, and that means during these 2 years they are locked in to a contract, so they supply these parts whenever there is a production plan. So if Dell has a production plan for 1 million units of Model X, right? Then the supplier will be notified of that production plan. And the production plan will be in in January they will produce 10% of it. February another 10%, March another 10%, and so on, right? So over 10 months, then they will complete production of 1 million computers, 1 million of Model X. So then this part supplier will and their computers will be online. So once Dell has this production plan, it will also show up on the system, on the part manufacturer's system, and they will know by January 1st how many units will be needed, how many parts will be needed. By February, how many units will be needed. So they produce, 100,000 units and ship it to Dell's plant, right, in time for their production schedule. This is called just-in-time inventory. The inventory of parts will be delivered just in time for their production schedule. That way, the manufacturer, Dell, won't have to maintain a warehouse for inventory, right? And maintaining a warehouse costs money, right? So that's called inventory carrying cost, because one of the biggest cost of inventory is warehousing. The other one is the other inventory cost is insurance. So there is inventory carrying cost and inventory ordering cost. If they order every time, there is no cost of ordering that inventory, the parts. But if they have a supply contract, then they don't have to place order every time. When they have production plan, this will be automatically notified to the supplier because their computers are online, and they will know, the supplier will know, supplier of parts will know automatically, and they will ship the parts in time for their production, Dell's production schedule. And Dell won't have to deal with the inventory carrying. So Dell will save on inventory carrying cost. And when they ship it, right, do they get paid immediately? When they ship these parts, do they get paid immediately? Now, I think this...
They don't get paid right away.
Huh?
I said they don't get paid right away on the question you asked.
Yeah. My question was, do they get paid right away?
No.
No. Yeah, when they ship the parts, they don't get paid right away. They don't get paid right away. And who gave me that answer?
I said to.
I said to. Okay, I said to. I'll give you another 0.25. No, they don't get paid immediately. Um, Usually, they get paid, like a month later or 2 months later, 30 days or 60 days. But um, that's usually, because when the driver, uh, so the part manufacturer ships the parts, driver delivers it uh, to the manufacturer. Then obviously driver doesn't get paid. Driver doesn't get paid for that parts, right? They don't. Driver just unloads it there and then leaves. The truck leaves, and then between the companies, it will be settled, right? It will be settled later. But then, so that's credit sale initiated by the seller. That's the credit sale initiated by the seller, right? But then, what is the so they owe, the manufacturer owes the supplier, part supplier, and if the amount, the dollar amount of the parts that was shipped was, $100,000, this $100,000, uh, what is the document that what is the document that proves or that confirms? What is the document that confirms that? What is the document that confirms the claim to that $100,000? Everyone is following me. I mean, my explanation was. I wish I could show
following,
you.
we're listening.
Huh?
I said we're listening.
I'm not sure what you were saying.
I said we're listening to you.
Yeah. You should, if you were listening to me, you should have, you should be following me. I mean, you should follow, what I'm talking about. I wish I could show you like this, like a small video, small movie. I'm describing all that can be, described by a small video, or just, I'm describing it verbally. So I'm not sure if you can follow, but if you have been following me, you understand what I'm talking about. I mean, the driver of the truck driver of the part manufacturer will supply part supplier will deliver the parts to the manufacturer, and he leaves without getting paid. I mean, he doesn't collect the payment at right there and then. The payment will be settled later, between these two companies. But then, what is the confirmation of the claim? I mean, if these parts were $100,000, the value, if the value of the parts were $100,000, what is the confirmation of this claim to $100,000? Invoice, yeah. Who said invoice? Who said invoice?
Anna.
Anna, you racked up a lot of points today already. But I'll still give you 0.25. Yes, invoice is the accounts receivable, right? Invoice is the physical proof of the claim to that credit sale. And this credit sale was initiated by the seller, right? So when we say accounts receivable, yeah, one thing is obvious, promissory notes, which is a buyer-initiated credit sale. And then we all understand, and if it is seller initiated, what is the physical side of the accounts receivable? Because people understand what accounts receivable is because the meaning of the word, semantics, from the semantics, everyone knows. That's something still to be collected. The company hasn't got paid yet. So it's something that still needs to be collected. But then, accounts receivable is only an abstract concept. It's only an idea. Isn't that right? Accounts receivable is only a concept, right? There is no such paper as accounts receivable. There's no physical thing that says accounts receivable, right? In other words, accounts receivable is a concept, and you think you understand it. Yes, you can understand because the meaning of the word, the semantics is quite straightforward. But what is the actual physical thing? What is the exact physical thing that uh, represents the accounts receivable? It's the invoice. So most of the accounts receivable is invoice. Okay, I hear a lot of background noise. Hello? The class isn't over yet, and if you are speaking to someone else, please, mute your microphone. So this is the breakdown of the current asset side. I mean, I already broke down the non-current asset side, which is, plant and equipment, building and land, and of course there's depreciation. But depreciation is, not of depreciation is simply the wear and tear of the and wear and tear and the resulting decrease in the value of these physical assets. So when you can see, I mean, physically the plant and equipment, building and land, you understand what the non-current assets is. But we are expressing it all in dollar values, so we have to also include the depreciation of those, physical assets. So that's the non-current asset. And current assets, I've been telling you, it's liquid assets. Liquid meaning, current doesn't mean, in the current assets, current doesn't mean the present, right? Current means liquid. Current means it's running, right? Like in French, courant, right? It's running. It's a current, like the water, the Gulf Stream, it's a current, right? Only the liquid assets can run, right? Physical assets cannot run. Hence the current assets. And I haven't talked about inventory today because we are already out of time. But accounts receivable, it's all promissory notes and invoice, right? And the invoice, here's the thing. Next time, we will have to talk about factoring next time. Factoring, because in principle, theoretically, in principle, promissory notes, you have to hold it for 60 days. I mean, if the maturity of the promissory note is 60 days. Invoice also, if you gave 60 days on the invoice for the buyer to pay, you will have to, in principle, you will have to wait 60 days. But in reality, no, you don't. You don't have to. You don't have to. You can collect early. You can collect earlier than the maturity date. So that's called factoring, and we'll be talking about. But before I dismiss the class, before you leave, let's think about the concept of asset. What is an asset? Asset is something that generates income. Asset is something that generates income. Asset must have income generating capability. Of course, in mathematically or accounting equation, assets are equal to debt and equity, debt plus equity, or liabilities plus equity. Liabilities plus equity. Yes, but then that is basically explaining where the assets came from, right? All these assets came from debt and equity. So in other words, debt and total assets must equal total liabilities and equity, because whatever you liabilities and equity are the capital that you raised through equity and debt, right? By borrowing money and by borrowing money from the lenders, and by raising capital through sale of stocks, right? You raise 30 million. Why? Because you need 30 million to first 20 million out of 30 million. You need that for your physical assets, plant and equipment, building and land. And then the other 10 million you need it for your operating capital. I mean, a current assets is not exactly the operating cap. Operating capital is only a small, part of the current assets. Operating capital is something you need to, support the company, support the business until you make your first sale, right? I mean, and after making sale, the revenue generated from sale will support the operation of your company. So, basically, liabilities and equity side is basically telling you where the that capital of 30 million came from, and the asset side is showing you or describing to you how that 30 million is held, in what form that 30 million is held. So that's the and they have to they must balance out, because it came from 30 million. It must add up to 30 million, right? They must balance out. Okay, and we need, of course, that was, if you raise 30 million, that was at time zero. If that is the total liabilities and equity at time zero, 1 year later at time one, this may have changed, because first of all, remember, equity, the company made, in income statement, company made, $10 million profit, and $10 million profit is equity. That already changes the equity value from equity at time zero to equity at time one. Equity at time one will reflect the EAT, right? So equity at time one is equity at time zero plus EAT at time one. So that means we need two balance sheets: balance sheet at time zero and balance sheet at time one. So beginning of the year, end of the year, it will show the change, and a lot of that change will be explained by income statement. So we need two balance sheets and one income statement, right? Generally, basically for the fundamental analysis. Okay, for fundamental analysis. But defining asset as, if we define asset as, asset is, how the capital raised, through debt and equity is held. I mean, you can explain asset like that. So that is accounting equation. Accounting equation is what? Assets is equal to liabilities and equity. So that explains, exactly whatever is raised, $30 million raised, through debt and equity is held in the asset, held in the form of, physical assets and non current assets. Um, that's one way to explain it. But to explain asset by itself, asset must have income generating. Asset is something that generates income. And if asset doesn't have income generating capability, then it's not, uh, it's a non-performing asset, right? It has zero asset value, non-performing asset. It may have only scrap metal value. All righty, so that's it for today. That's it for today. So any questions so far? Any questions?
No.
Okay, I guess that means no questions. So I will see you guys all in the next class, which will be September 25th. I will see you then. And don't forget your homework one is due 11:59 September 25th. Okay. Alrighty, I will have to stop recording. The class is dismissed.
Have a good
I will
day.
see you
Thank
guys.
you.
I said to, were you saying goodbye or were you asking a question?
No.
You were saying
I was
goodbye.
saying thank you. Bye. See you.
All right, you take care now. Have a good weekend,
Same
everyone.
to
Have a good one.
All right, you too. Take care now.